Mortgage interest rates on the rise again for buy-to-let investors. I'm pulling my hair out. Buy-to-let investors will again be concerned that interest rates will rise again, as some lenders have increased rates in mid-January 2025. Why is this? Well, this increase is not in response to a rate rise by the Bank of England. Oh no, not this time. It's rather the fact that bank swap rates have risen slightly due to recent volatility in the bond markets. You might have seen on the news information about bond yields. Okay, so what does this all mean for you as a landlord, and more importantly, how can you prepare for these changes that are outside of your control? I am going to share how interest rate rises can impact cash flow and some of the things that you can do to mitigate any damage to your income and your cash flow. Please note this is not financial advice, but rather mitigations within your portfolio to cushion the blow of any interest rate rises. Now, we know this is outside of our concern and we can't do anything about it, right? This stuff is happening out there to us, not with us. So to give an indication of how interest rate rises can impact your portfolio, I just want to give you an easy little calculation to do. If you've got a 1% interest raise for every £500,000, this would mean an additional £5,000 in interest repayments. So on a small buy-to-let property, it's effectively going to wipe out your cash flow in many circumstances with a 1% rise. And let's be honest, we know in the last few years, we've seen much bigger interest rate rises than that. So what can you actually do to mitigate this? Well, one of the things you can do is consolidate, sell some properties and pay some of your mortgages down. However, that might not be an option for everybody. So let's talk through some of the things landlords can do. Now, I believe in giving my tenants amazing homes to live in, but I also increase my rent slightly every single year so that my tenants know that that's going to happen. I don't give big increases, very small rent increases in small increments, usually around inflation rate, okay? This then means that your tenant's rent rises in line with the market, and should you ever have to evict a tenant, or if a tenant has to leave and get somewhere else to live or move, they will not see such a massive increase in one go. So this in some ways can help our tenants manage the increases. So you should be putting up your rents by a small amount and making sure your tenants have a great home, but with small rent increases. The next thing we should do is we should enable ourselves to gain access to bricks and mortar valuations or commercial valuations. And I talk about this on other episodes on my YouTube channel. So please go and like and subscribe so you can get access to all of my content and all of the tips I'm sharing on YouTube. So if you can gain access to both bricks and mortar valuations and commercial or hybrid valuations, particularly on HMOs and blocks of apartments, then this is really important because you will have smaller interest rates on those comparable bricks and mortar mortgages versus commercial mortgages, okay? The other thing I'm just going to mention is I personally do not like portfolio mortgages because portfolio mortgages charge normally about 2% higher interest than commercial mortgages, and commercial mortgages are 2% higher interest than buy-to-let mortgages. So the lowest interest rates are available on lower LTV buy-to-let mortgages. Here's a tip. Look at newer property strategies, such as multiple property purchases, flats or mixed use, so a shop with tops as we call it, or flats, and title split on purchase. Always title split on purchase and keep some, sell some. If you sell some, you can have smaller mortgages on the ones that have left. This is called decreasing the LTV, loan to value. This can increase cash flow by reducing your loan to value on your mortgages. Really important. So don't be over leveraged. I wouldn't recommend. Now, the next thing is reducing your portfolio size. So you could pay down some mortgages by selling off other properties. Now, everybody has to do different things that are right for their portfolio, but this is one of the ways that you can reduce your mortgages, okay? Because we want lower loan to values when interest rates are high. Number 5 is make sure your stock is top of market, high end to reduce voids. So if you have amazing homes for people to live in, they tend not to leave and you won't have voids. And the final thing I'm going to say, so important, number 6, reference tenants properly. Reference your tenants and advertise through reputable agents and find the right tenants who can afford to pay the rent for your property. And if you do that, I always find my payments of rent are on time and they come in every single month, so I don't have any rent missing, which equally will make this situation worse for you. So all I can say is it's about managing your portfolio stock effectively, reducing your mortgage coverage if you can, and actually you can still make buy-to-let portfolios work. Come and talk to us at titlesplits.com if you want to learn more about how you can use this strategy to buy property and also reduce your LTV on your loans.